Hello, this is Dr. Seitz, and today we are going to talk about Chapter 6 and do a demonstration problem with a bank reconciliation. So the problem I have for you should be on Blackboard already, but I'll go ahead and read the problem. And then, like I said, you should have that, so I won't be flipping back and forth between screens, which will make you sick. So here is the demonstration problem that we're going to be doing today. We're going to look at the bank statement for Greenbrier Furniture Stores, and it showed a balance of $63,289 as of November 30th. The unadjusted balance in the general ledger account, cash account at November 30th was $59,345. So after we look at the bank statement and then we look at the general ledger or our books, which is essentially like the check register that you have, okay? When you look at your check register and you look at your online banking, or you actually get the statement and you look at it, and they typically have different balances. Our goal with a bank reconciliation is to try to find out what the quote unquote true cash balance is. So essentially, what are the differences between the two? And do we need to make any adjustments to our accounting records, which would be like you making an adjustment to your check register, or did the bank make a mistake, which sometimes happens? So we're going to reconcile the balance shown on the bank statement. We're going to identify 3 events that would require them to make adjustments to their own check register, the general ledger cash account. And we're going to record those events. And then we're going to identify what the book balance is after it has been adjusted. Okay, so the following information was found. There was outstanding checks that totaled $24,598. And as just a reminder from your reading, outstanding checks are checks that we have written, so they are in our check register or in the general ledger, okay, but they do not show on the bank side that they have been cashed, okay, so they're just outstanding. They're out somewhere and they have yet been brought to the bank to be cashed. The bank had issued a $157 credit memo for interest deposited into their account. So essentially this is monies that the bank has on their financial statement, the bank statement that we have not yet, because we have not yet recorded, because we have not got the information, which is when you get it, is at the bank statement time. So you would have interest in the event that they are keeping some of your deposits and collecting interest on it and lending it out. The bank statement, the bank had deducted a total of $469 for 2 non-sufficient funds checks. So NSF checks, those are something that we went ahead and basically what had happened is a customer came in and they paid on their account, but then when we went and took their when we went and took their check to the bank, we found that there was not enough money in their account. So we would have already increased our cash and decreased their accounts receivable to us, but the bank said, no, hold on, they don't even have money in their account, so you need to take these back. So we're going to have to decrease their account and then put back on their accounts receivable so they go to pay us again. The bank statement enclosures included a debit memo for $36. The bank had deducted from Greenbrier's account to pay for new checks. So you had ordered new checks, and they take your payment by just directly taking the money out of your checking account, which is that $36. So they've recorded it, but yet you have not recorded it. Deposits in transit were $19,060. So similar to what an outstanding check is, deposit in transit is a deposit that we have recorded, but the bank has not yet recorded. And what that means is possibly it hasn't been taken to the bank yet, which is not really good internal control. That's not good practice. Or it could be just from an overnight, maybe you put it in the bank, but they have not yet processed their overnight deposits, which is typically what happens. Or you deposit on the weekend and it doesn't post till the next business day. And so things like that happen. The bank had mistakenly deducted from Greenbrier's account a $1,246 check drawn on the Green Bay Company. And so here's an example of where the bank made a mistake. Now, this does not happen very often, okay? More often than not, it's user error. It's not necessarily the bank error, but it can happen. If their accounts, if somehow the checking account number got typed in wrong, or account names got confused, or whatever, this does happen. But always double check and make sure it's not your error before you contact the bank asking them or actually losing control, because that's what most people do. I've worked at banks the majority of my career outside of academics, and people lose their minds whenever their accounts aren't what they think they should be, which is understandable. All right, so I'm going to pull up this work paper here. So the very first thing that we had to do is prepare this bank reconciliation. This unadjusted balance, this is essentially, let me get this to work here. This unadjusted balance, this is what the bank statement, because notice it says bank balance and book balance. So this came directly from the bank statement. The $63,289 came directly from the bank statement, and then from our accounting system, or if you were doing your personal checking account, this would come from your check register, the $59,345. Okay. Now there are certain things that we add to the bank side, certain things that we subtract from the bank side. So the very first thing that I always remember to add to the bank side are those deposits in transit. And if you remember, that total is $19,060, and that's because it's already recorded in this number. It's already recorded in the $59,345, but it's not recorded in the unadjusted side. So we don't need to add it over here to this book balance because it's already in that number, but the bank does not show it. And essentially, that bank error for that Green Bay check of $1,246, that would need to be something that would be added back to the bank balance. So remember, the bank had mistakenly deducted from your account this check, and that wasn't even on your account. So we need to add that back to the bank balance because we would have never subtracted it from the book side. So we need to add this back because they mistakenly taken it out of your account. Okay, so I'm going to put bank error. Okay. Some other things that we would need to look for is things that we would subtract. So we always look for the outstanding checks. So the total of the outstanding checks is $24,598. Now in practice, I like to actually list them all out separately and then come up with the total, but there's not enough room here. But in practice, I would list them all out separately, and then I would come up with the subtotal here. So therefore, doing the math, if you had $63,289, you added these two numbers, $19,060, $1,246. You subtracted out these outstanding checks, $598 or $24,598. You should come with a true cash balance of $58,997. Now remember, the outstanding checks are checks that are already included in here. They've already been taken out of this book balance. Okay, they're already included in here, and they're just somewhere out there floating around until the person that we wrote them to actually takes it to the bank. So something that we add to the book side. So now I'm going to move to the book side. I came up with this true cash balance. This is the magical number here. I'm going to move over here to the book side, and I'm going to add my interest. Okay. Now, some other things that could possibly be added to this side is if, say, for example, they collected an accounts receivable on your behalf. So your customer actually sent in a check, and then it was automatically deposited, like sent it to the bank or did like a bank transfer, and then automatically deposited into your account. That would need to be recorded there. And then we would also need to record that check to decrease the accounts receivable and increase our cash. So that would be the transaction that would happen there. But that's the only thing that we have in this particular example. The other thing that we need to do is subtract out. So that NSF check, that check that was bad, that $469, we went ahead and added it when we deposited it. Well, we know it's a bad check, so we need to back that out. And then also we had this bank charge, and this could also be like a bank service charge. I didn't mean to write bank service charge. Bank charge. This is for the checks, but sometimes banks charge you to even use their services. And so that would go there. That would be a subtraction that you would have not already had right here in your book balance. So the $59,345 plus the interest of $157, subtract out the NSF check that was bad, subtract out the bank charge, you're going to come up here with a true cash balance of $58,997. Now this is great that they match. That's the whole purpose. That's what we want to do. The thing is, though, is even though the bank doesn't show that that's the balance, that's fine. We don't need to do any adjustments on the bank's books. That's not for us to do. Our adjustment that needs to be done is this $59,345. So we need to do the adjustments necessary to reconcile those two balances. And so that's what requirement B is basically asking us. What are three things that would cause us to have to make transactions into our books. So if you notice here is 1, 2, and 3. So the very first thing is that we need to record the interest income, which is what this 157 is, the interest income. We need to decrease our cash account and increase the customer's account that gave us a bad check because they still owe us. So we would have written down their accounts receivable, and now they need to come back and actually pay that accounts receivable. And then also this $36 is for the checks that we had purchased. So those would be the 3 items there. So what would that look like in a horizontal balance, a horizontal financial statement? Well, the very first thing that we would do is we would add in cash. That's that cash that, I don't like red, hold on. That's the cash that we would have received for the interest, okay? And then that would be in our revenue. So that would increase our stockholders' equity. And that would hit our statement of cash flows. We'd increase our net income as an operating activity. The next thing is a decrease of 469 and then an increase of 469. That's for that bad check that does not hit our financial statement. And that does decrease our $469 as an operating activity because cash actually, when there's cash, when this cash account has been increased or decreased, that's when the statement of cash flows comes into play. So every time you have an increase or decrease on this cash column, you should have an increase or decrease on that statement of cash flows. And then finally, for those checks, $36, and that would be an expense, some sort of bank service charge expense, just depending on how you would call that. You can see how that affects the statement of cash flows. Okay, so what should the balance in the checking account be after all these adjusting, because these would be called adjusting entries. What would the bank balance be? Well, it's this magical number here, this 58,997. Okay, and that's because once we took this beginning balance of 59,345 and we added and subtract, we came up with it on paper of 58,997. But we still have to do these adjusting entries that we show down here in requirement C. Otherwise, our financial statements actually don't reflect the new quote unquote true cash balance, and therefore not reconciled. So the purpose of reconciling is in your reading, you found out that cash is the most susceptible asset to fraud. It's pretty easy to take. It's the most liquid asset. And so when someone steals cash, they can actually just turn around and buy things with it. And so that's different than them stealing supplies or stealing actually inventory, because they're going to have to liquidate those things if what they're wanting is cash. I can steal inventory and actually use it, sure. And I can steal supplies and actually use those things. But really, cash is what people mostly want whenever they're committing fraud. So this is called a misappropriation of assets. It happens on all levels of an organization, from top management down to lower management. And so we need to make sure that we are understanding why there are increases and decreases to this cash account. And so somebody must be completing the bank reconciliation. And in theory, there should be a segregation of duties happening. And you should have read about that in your textbook too, in regards to internal controls. So a segregation of duties is where the same person that's writing these checks or making the deposits should not be the same person that is reconciling a checking account. Theoretically, it should be somebody who doesn't even have access to cash, because in the event that they do have access to cash, they can make this financial statement, this bank reconciliation, say whatever in the world that they want it to say. Now, sometimes it's not possible to have somebody outside of the cash handling process do that. And so what you do is you have management also sign off on it. So once this particular bank reconciliation is done, I can sign off on it and then date it, saying that even though I'm not the one that prepared it, I actually reviewed it and I agree with it. And so I worked in an organization to where I made the owner do that whenever I was reconciling this cash account. And currently I consult with a nonprofit organization who has a board member actually reconcile the checking account. So there's a few ways to get around the segregation of duties, or I don't mean get around, but actually satisfy those segregation of duties. But that's the reason why. Sometimes we feel like internal controls are a burden. And if we take a step back, and I hope that you've read this chapter thoroughly. This is by far my favorite chapter. This is what I do a lot of my research in, is fraud and financial statements. And I was an auditor and absolutely loved auditing and trying to figure out how to best safeguard assets, whether it's for an owner or for a shareholder. Then we understand the purpose of them. And so this is how you can add value to the company that you're even currently working at today. All right, let me know if you have any questions, and otherwise, I'll get started on the next video.